One.
Hello, everyone. We can wait a couple of minutes and just to see, give everyone a chance to come on in. We'll get started around 11:03, I would say. But good morning to everyone. Good morning, everyone. Welcome. This is our Bay Area home buying webinar, and we are so excited to have you here. We're hoping to show you what's going on in the market here in the Bay Area, and also kind of give you an idea of the steps you can take to move forward with a new home. We have 3 other presenters other than myself, Christy Farrow, Chris Walker, and Deandra Avalos, and they're our TMHF colleagues. And they'll introduce themselves when their portion of the webinar pops up. But right now, I'd like to introduce myself. My name is Veronica Robertson. I've been with Taylor Morrison since 2013. I've been in the industry for a very long time, mostly in new home, well, all in new home building, and but predominantly in sales and marketing. I focused a lot on market research, though. So yeah, it's always been a big interest of mine to really know what's going on in the market. So so I'll just kind of give you a little recap of how we're going to move forward. We're going to talk a little bit about Taylor Morrison and kind of who we are and what makes us unique. We'll talk about a Bay Area market update, just be brief about it, put some facts behind all the everything you're hearing in the news. We'll highlight benefits of new home ownership and kind of what's trending in design, and we'll talk about the great lender incentives that we're offering that we're offering to buyers. It helps defray the cost of ownership and makes it easy to move into a home. This is something that I don't know that any other new home builders are doing, but we're very excited. And I think your clients, if you all will find out that you can afford a lot more home than you realize. And then we'll talk about next steps. We hope you enjoy your time with us. We are so excited to have you here. Hopefully you learn about some great opportunities, and we'll also send a link out to this presentation after the call, so you can kind of go back on anything that maybe wasn't clear. So let's get started. So we have a 100-year history. We've been around a really long time. We've grown to be the 5th largest home builder in the nation, And we're active in over 20 markets. We span a wide range of demographics. We cater to first-time buyers. We've got move-up homes, and we also have active adult communities. So really wide market coverage for us. We've been recognized by Fortune magazine as one of the world's most admired companies, and we are also a member of Bloomberg's Gender Equality Index. And we also have a female CEO, Cheryl Palmer, and she makes us a lot different from most other home builders, and she really has she adds a personal touch to the company, makes us a lot different from our competition. So I'd like to just sort of talk about what's going on in the Bay Area market. There's, I'm going to not tell you anything that you don't already know. We've got a very highly educated population with some of the most culturally diverse communities in the nation. It's what makes the Bay Area great. We're so lucky to have a very diverse economy that doesn't rely on any one industry. And so while I won't say that makes us recession-proof, it certainly makes for a softer landing. We've got the top universities, we've got some of the biggest companies, and some of the most beautiful scenery. We've got the ocean, the mountains, wineries, all that, and you can drive there in a day. Also, we've got a high level of median household income, 119,000 at last count. That's higher than much of the state, or outpaces the state and much of the nation. But again, the economy is just so diverse that it makes it so that we don't rely on any one particular industry. So that's an advantage. Now on the supply side, kind of give you an idea of what's going on here. I know you probably hear in the media that prices are dropping and that everything is horrible, but I just kind of want to give you an idea of what's really going on out there. So months of resale industry inventory. This is a graph that shows from 2017 to 2022. Right now it's kind of hard to see that we have a very low inventory of resale. Right now we're at 1.5 months. I think at some point, in this 2017 to 2022 time frame has always been considered a pretty active market. It wasn't, during a recession or anything like that. And it's pretty common to have between 1 to 2 months of resale supply. Our economists say that 3 to 4 months or even 6 months is an equilibrium. So it's a pretty constrained market. So if you're having trouble finding a home in the resale market, that's probably why, because there's not a whole lot there available. Foreclosures that you can see at I think that was probably the end of the Great Recession. We had a very high level of foreclosures and REO sales. But as the years went on, we are really down to negligible numbers of foreclosures. So healthy market. And the other thing I would call this is a normalizing market. You can see, I know this graph is kind of hard to, there's a lot going on this graph, but the blue is the sale price to list price ratio. So that is what, someone puts a home out on the market, and then what it eventually sells for is the ratio that we're talking about here. So it's at 102%. So if something sells for, someone lists it for 500, it'll go for something above that. Whereas it used to be 116%. So people were overbidding and also, they list the home, and then you would end up having to bid for a lot more, and then there were multiple offers and that kind of thing. So we're not seeing that as much, but they still are, homes that are priced right are still selling, which is great. Also, the time on the market to selling is 24 days. It was down to as low as 11 days, and at one point it was up to 39 days. But we are in a very normalizing market, and it seems like that might be at least a little bit easier to handle for people, and it won't be as discouraging for people who are looking for homes. So that is next slide. The other thing that you're probably hearing a lot about are interest rates. And although historically the rates that we're seeing right now are definitely not out of the ordinary. If you've only been in the market for a little bit, it was what you were accustomed to, these very low rates. And so right now, what we're seeing is probably a bit of a shock to you. But in the historical sense, it is pretty normal. From this graph starts in 1971 and it comes to present. So it's a very wide span of history where you can compare what interest rates have been historically like. The good news is we have our Taylor Morrison Home Funding partners, and we are offering some great. We have some offerings that will help you defray the cost of homeownership, so you might be a little bit more comfortable with what we're offering here. So we're glad you're here to learn about this. Okay, so all of this is kind of what we're leading up to. You know, I would never bet against the Bay Area market. It is something that I've been involved with over a very long time, and over time it has always appreciated. And as it says here, it appreciates slightly higher than inflation, but even better, you get to take advantage of everything that's great about homeownership, and that's creating a space for your family and creating memories and making the home the way you want it. All the while you are enjoying the tax benefits, and your rent's not going up if you're a renter right now, but so really trying to find the best deal or waiting is not necessarily to your benefit. It seems that being in the market, just get in the market, is what you need to do so that you can start enjoying all of this versus timing it for the best deal. So the other advantage to working with Taylor Morrison is we have curated these beautiful packages. We have a team of designers who got together and figured out what the latest designs were, and we then worked with our purchasing teams who made sure that these latest designs are something that is readily available. I'm sure everyone has heard of supply chain issues, so having these on hand, and you can mix and match among the various packages, having these on hand ensures that we can procure the materials, have them on time, and give you an accurate, or we can pinpoint better a close of escrow for you. I don't know if you've heard, maybe your friends are buying from competitors, and there's just been so many delays, and a lot of it is materials. So this causes them to have to reselect, and having these on hand and making sure that it's something that we can procure easily will ensure that we can close the home and you can start living your life. So we are a one-stop shop. We have a team of experts that will help you. So if you're not sure where to start, the best idea is you're going to go to the internet. We have a team of internet home consultants here in the Bay Area. It's Camille. And if you reach out to Camille, she's going to help you figure out where you would like to start your search. And based on your price point, she'll make an appointment for you with our community sales managers. They know everything about their particular community. They can talk to you about the canvas packages that I just referred to in the last slide with the beautiful packages that you can choose from. Our construction superintendents are are there every step of the way. You'll receive updates with our community sales managers and construction superintendents every week, telling you what's going on with your home and probably send you pictures. And we also have our loan consultants with TMHF. They are all there to guide you with finding the best loan configuration that helps you in your particular situation. And then we also have our Aero consultants. So these are an experienced team that guides you on improving your ability to qualify for the loan. So if you have any kind of questions, we have someone who can help you with that. So I am going to turn it over to Christy Farrow. She's our TMHF colleague, and she's going to take you through the next part of the seminar.
Thank you, Veronica. Hello, everyone, and thanks so much for joining us this morning. Just a quick intro about myself. I've actually been with Taylor Morrison for over 20 years and have called Taylor Morrison home for the majority of my career in the mortgage industry. And I know this might sound a little crazy, but mortgage financing is truly a passion of mine. And, you know, working for a new home builder, it really keeps us centered on being part of that home buying journey versus, you know, some other mortgage loan originators focus also on refinances. We are 99.9% focused on helping Taylor Morrison home customers. And we're here to really ensure that our Taylor Morrison sales team and our mortgage teams are working together to help you achieve that dream of home ownership and have a really seamless experience. I actually oversee our Florida region, so I am on the catty corner of the country from you all, and I'm in Orlando, Florida right now today. But I do assist nationally with sales training and marketing initiatives, and we're going to be really excited towards the end of this webinar to share some of what those are as far as financing incentives are concerned. So we'll probably spend the next 20 or 30 minutes just really going through high-level mortgage, but I'm going to kick off the financing portion and have a couple of my colleagues here joining me as well, so you don't get completely bored just hearing my voice. So moving over to just really highlighting the seamless home buying experience. I would think most of us would probably agree buying a new home should be a really exciting time. And, you know, Veronica just touched on that emotional versus financial portion of buying a home, but the financing side of purchasing a home isn't really the fun part. And, you know, again, whether right now you're looking to buy your first home, maybe you've been there, done that, and it's just been a while. Buying new construction, if you haven't ever bought a brand new home, it's a very unique experience compared to purchasing resales. And then having that construction, finance, and closing all under one umbrella is truly a better path. You know, Veronica said one-stop shop, and that is absolutely the case because it will relieve that burden of that communication between your builder, your lender, your settlement agent, and your realtor if you're working with one. But in addition to mortgage services, Taylor Morrison works with a preferred title company. They also have another affiliated company, Taylor Morrison Insurance. And TMI, Taylor Morrison Insurance, offers competitive homeowners insurance premiums, just giving you another option to shop your insurance when that part comes due. And then all of our departments work hand in hand, ensuring to make sure that financing is ready when your home is. And again, we appreciate that a home purchase is emotional and financial, and it is truly the largest purchase likely that your family will ever make. So we take that with a lot of pride and a lot of sensitivity. So over the next segment of our webinar, we're going to touch on some high-level loan qualification components. We'll share some information about Aero department that Veronica mentioned, Able, Ready, Own. And then last but not least, we're going to introduce you to Dorothy. That is our mortgage technology platform. So as we walk you through the presentation, I just want to let everybody know that there is the live event Q&A. So you are welcome to post some questions. We've got a team of experts on the phone that can help answer some of those. And Veronica will give you some contact information at the end if you have other questions that maybe we didn't get to today. But the recording and presentation will be sent out either late today or no later than tomorrow. So let's move on and just, we're going to touch high level on these 4 C's of mortgage qualification. So I'm going to just appreciate that some of you may currently or have previously owned a home. Some of our other guests might be first timers. So we're just going to give some basics to loan qualification. And for those of you who have already experienced home ownership, maybe it's been a while, we're just going to give you a refresher. So we figure that can't ever hurt. Many of our industry professionals will refer to the foundation of loan approval as the 4 C's, as you see up here on this slide. I personally prefer to compare loan qualification to the 4 legs of a chair. Just considering that most of us probably wouldn't sit in a chair with wobbly legs, and mortgage lending really is no different than that. And as a lender, we want to be sure that the qualification has those 4 strong legs and gives that stability to have the comfort to move forward and make sure that you can be in your home for years to come. And just appreciating that when we are lending hundreds of thousands of dollars, we have to understand these 4 pieces. One being the value of the property, that is your collateral. We have to understand your ability to save funds to purchase the home and your ability to repay the loan, and then whether or not you have the strength in that credit history to pay debts timely. So we'll touch on these individually, give a general understanding of qualification, and then hopefully we can help you assist in discovering where you might be in that journey to homeownership, especially for those of you on the call that might have qualification top of mind today. So our first C, property appraisal reports. These are required on every single loan transaction unless you're, unless you're paying cash to purchase. So if you do choose to pay cash to purchase your home, an appraisal is not required because you don't have the lending piece of that. But appraisals nowadays, probably for the last, 15 years or so, they are completed by an unbiased third-party licensed appraiser, so there's never any influence given by either the lender or you, the home buyer. And we have to be sure that we're lending appropriately to the value of the home, while you want to be sure you understand the value of the home you've purchased compared to the price you agreed to pay when you went under contract. Closed comparable sales from like-size properties are what's truly used to establish that value, not homes that are currently under contract and pending their final close of escrow. So on that rare occasion that an appraised value would come in below purchase price, we get this question a lot when we do these webinars. I want to just explain that there are so many ways that we resolve that through home financing. Many times there can be an increase to your loan to value that has no impact at all to financing. But if we do discover it is impacting the financing, there's so many resolutions, whether that is covering upfront mortgage insurance that you can pay at closing, or giving assistance with cash to close should more down payment be needed to meet the program guidelines. But what we do realize is, reducing price to mirror those past closings, it's not truly the best option for consumers or obviously sellers, as it does have that potential domino effect of home depreciation within the community. Veronica touched a little bit on what is happening in the market right now. And I think it is good to just recognize that home prices have appreciated over the last 2 years exponentially, and that's so much so because of these low interest rates that she mentioned. Nationally, we've seen home prices appreciate the last 2 years, 9 and 15% respectively. And those rising interest rates that we're talking about, although historically still very low, it has obviously slowed new and existing home sales in recent months. But we are anticipating that home appreciation will level out to historical averages of about 5% a year. And again, as Veronica mentioned, we don't expect significant correction to the market, similar to what so many people felt during the housing crash of 07 and 08. And there's a couple reasons. One, we believe the primary reason is due to prudent lending that provides credit to borrowers who can truly afford to purchase and hold that strong equity in their home. You are required to have a down payment, and we know that, 20 years ago, that wasn't necessarily a requirement all the time. So there wasn't a lot of skin in the game. But second, we're still seeing, as Veronica mentioned, that low housing supply, and some of the highest housing supply was back before the housing market crash. So appraised value just seems to be something that a consumer worries about, and what's happening, and is it the right time to buy? But what we're not seeing is that decrease in price or home depreciation, as some might be a little bit fearful of. With that, let's move on to our next C, which is our cash. And obviously, down payment is required unless, and my colleague Chris will talk about this in a little bit, unless you're looking at VA financing. But when you are putting your down payment for your loan, the lenders always need to verify that source of funds that are needed for the down payment, and any of those closing costs that are needed to be paid to complete the purchase. So when we look at the maximum loan amount, it is determined by the sales price or appraised value, whichever is less. So that minimum down payment is going to vary by loan product. It could vary by an occupancy type, whether you're buying a primary residence, a second or vacation home, or perhaps an investment property that you plan to turn into a rental. But the guidelines that are established for where your down payment funds can originate from, I've included up on this slide, both the acceptable and unacceptable sources for down payment. And the main thing that I always like to point out is making sure that you do not have any transfers of funds in and out of bank accounts or deposits that are not payroll that you wouldn't be able to source. So as long as you have that paper trail to provide, moving funds from savings to checking or retirement to savings, that is perfectly acceptable. And we also have many loan products that accept gifts from family members, sale of another piece of real estate. So I just like to make note that, if you're somebody that likes to stash that cash under your mattress, that could cause this one leg of your chair to be a little bit weak. So we want to make sure we can source your funds. And that would be pretty much the highlights here on cash and down payment. But with your cash needed, you will, at time of contract, be expected to provide the seller with an earnest money deposit. Taylor Morrison is going to have a required deposit, but it varies by market, it varies by community. So those questions I would direct over to the community that you're looking at specifically. But earnest deposits are applied towards your down payment at the time your home closes. So if you're getting financing versus paying cash, it's very important that you have the ability to provide the proof of those deposit funds and source where they came from. So sometimes in new construction, you may have, 6, 9, 12 months before your home's ready, and you give your earnest money today, but you don't close until next spring. Those bank statements where those funds came from would need to be provided to just show that source. So if you have any unique circumstances, again, just know that we have this team of local loan consultants that are always able to answer individual questions if something feels a little bit unique to what we're talking about today. And then lastly, on the topic of funds needed to close are the costs associated with your settlement charges. And I just want to touch on interested party contributions. So beyond that down payment, buying a home, the closing costs will typically vary anywhere from 1.5% to 4% of the purchase price. And that includes everything from lender and title fees, government fees, transfer taxes. There's going to be prepaid items like your first year of homeowners insurance, or perhaps you're setting up an escrow account to stash away your real estate taxes and homeowners insurance in preparation of next year. Those are all collected at the time of closing along with the remainder of the down payment. Some loan programs do allow for those tax and insurance escrows to be paid annually and separate. So that sometimes can reduce the cash needed to close. And then I would mention that some Taylor Morrison communities have homeowners associations. So there may be fees at closing associated with that. But again, that's community specific. But just to touch on interested parties, the interested parties in your purchase would either be a seller, a lender, or a real estate agent. And none of these parties can help you with down payment. However, they could choose to assist with any costs associated with financing. So whether a real estate agent decides to help with commission, help pay towards these costs through commissions, or as a lender, we provide you a lender credit, or as the seller, for example, Taylor Morrison provides incentives. Those just have to stick towards the cost themselves. And then certain loan programs do have a limitation based on the program, the percent of sales price that can be given. Most loan programs allow for up to 6%. And again, we'll touch on that as far as what Taylor Morrison and Taylor Morrison Home Funding are doing today to help with that. So we'll talk about that towards the end. But moving on to our third C before I hand it over for Deandra to bring home our building of our chair, we will talk a little bit about capacity, which is going to be your employment and your income. Next slide, please, if you don't mind. Thank you. Capacity is just referring to that ability to repay the mortgage, looking at job stability and the likelihood of the income continuing. So it's really important to mention that mortgage approval is based on your gross income, not your net income or what you bring home. So Chris is going to hit on that a little bit when we talk about monthly income and debt ratios and how to understand your maximum spend, but I just want to kind of make note of that. And when we talk about job stability, we're looking for 2-year job history in the same line of work, but not necessarily the same employer. There are exceptions to that. So we many times have families where there's been a gap of employment due to a hardship, or someone took time off for family reasons and now they're re-entering the workforce. You could have a college student maybe who just graduated and they're now getting wage earning work in their field of their degree. That also could be considered. So the only thing sometimes that can get a little tricky is self-employment, because we do need 2 full years of self-employment and then a 2-year average on tax return income. So we're always willing to do an analysis of tax returns even before you purchase, because that is not typically as black and white as a W-2 wage earner. So that deeper dive could be done and just really understand what's being reported on tax returns through write-offs and what that looks like compared to maybe the simplicity of a pay stub. So if for some reason anyone on this call is self-employed and they just feel their income stream might be unique, again, I always encourage anyone to reach out to our team of licensed loan consultants, and we can answer those questions, uncover obstacles before you purchase, which I believe is, just a great way to make sure that you don't enter into something and then have the disappointment maybe of finding out that, it's a not yet type time for you, but hopefully we can help get you there, which really does lead me into my introduction of Deandra Avalos. So Deandra, I'm going to go ahead and let you bring us back down to our credit to help finish building our chair. And I will be back with you guys in a few to talk about our finance incentives. Thanks, Deandra.
Thank you. I've been in the mortgage industry for 22 years, and I was fortunate enough to find my home with Taylor Morrison about 14 years ago. To say I was excited when presented the opportunity to be a part of our aero department when it was envisioned 11 years ago is an understatement. Chrissy had mentioned how finance is her passion. For me, it's credit and the ability to educate buyers on the ins and outs to help guide you to your new front door and achieve your dreams of home ownership. Credit is like a thumbprint in its uniqueness, meaning no 2 customers' credit profiles are the same and each one tells a story. When looking at credit scores for a mortgage, we'll pull a tri-merge credit report, which simply means that we're going to pull a report from all 3 bureaus. Equifax, TransUnion, and Experian. Residential mortgage credit reports will many times score differently than a consumer report, and the qualifying credit score for loan approval, interest rate, and mortgage insurance premiums are based on the median or middle credit score. If one or more borrowers are on the mortgage loan, it's going to be the lower of the two median scores that will be used for qualifying. This visual provides a look at what factors make up your overall credit score. And as you can see, 65% of your credit score is based on timely payments and overall credit utilization, which simply means how much you owe against how much available credit you have. Next would be the age of your credit history, followed by new credit, and the mix of credit types like student and car loans, revolving debt, and even a mortgage. There's quite a bit of information on the slide regarding credit basics, and I'd like to mainly touch on the difference between a soft inquiry and a hard inquiry. There are a lot of myths about credit inquiries, but a soft credit pull doesn't impact your scores. These would include things such as pre-approved credit cards, checking your own score on Credit Karma. It could also be an employment verification. A hard inquiry would happen when you directly apply for a credit card, any type of loan like the student loan, auto loan, mortgage, or even a personal loan. These inquiries will remain on your credit for 2 years and could cause small incremental decreases in your overall score, but on average, it's less than 5 points. Only 14% of consumers lose more than 10 points because of an inquiry. And 89% of the time, inquiries aren't even one of the top 4 factors that are impacting your score. So when shopping for a big loan, such as a mortgage or an auto loan, you typically won't get an incremental ding if you're shopping around within a 14 to 45 day time frame of that initial inquiry. You may have already gone through a pre-approval with another lender. You might be concerned about another inquiry on your credit. However, when you pre-apply for a loan with Taylor Morrison Home Funding, we will only do a soft credit pull, which provides us 2 of your 3 scores. Once you make a decision to purchase a home and move forward with a formal loan application, at that time we would generate the tri-merge pull with a hard inquiry taking place. We're going to be sending out this presentation for you to review all the credit basics, but I'll quickly mention that employment, income, and bank balances have no impact on your score. But as Christy talked about earlier, they're both main factors in your loan approval and typically indicate a strong payment history. Taylor Morrison Home Funding has a department designated solely for qualification improvement and loan enhancement. It's our ARROW department, or Able, Ready, and Own, where we offer a personalized strategy to help enhance credit and provide guidance on education to assist you with the path to home ownership. ARROW is not only for those seeking credit score improvement to gain loan qualification, it's also for those with great credit that are seeking score enhancement to provide additional financial benefits with your interest rate and maybe decreased mortgage insurance premiums. ARROW is a complimentary service for both prospective homeowners as well as those that are already under contract to close on a home. You are under no obligation to purchase a home and will tailor a path specific to your needs. After applying or pre-applying with Taylor Morrison Home Funding, your loan consultant can enroll you in our ARROW program, where we will run credit simulations based off of your tri-merge credit report and provide a personalized improvement path based on your needs. ARROW isn't classic credit repair, meaning we will not speak directly with your creditors, and it does require your participation in order to complete our ARROW program and become an ARROW graduate. Some examples of ARROW recommendations would be suggestions to open a new account, be added or removed as an authorized user, pay off accounts or reduce balances on your current credit cards. If you've applied with Taylor Morrison Home Funding, our ARROW consultants are familiar with your financial profile, and we work hand in hand with your loan consultant and Taylor Morrison to ensure we are not making recommendations that would hinder your ability to purchase, such as utilizing your down payment funds to pay off debt. We engage with you and help you stay on task with open communication by phone and email. In just the last year, we've assisted hundreds of families with an average time enrolled of less than 90 days. And over the last 10 plus years, we've helped over 4,800 families achieve the dream of home ownership through qualification improvement while also gaining financially through score enhancement. If at any time you think we could be of assistance, you can start by reaching out to our local loan consultant team. And with that, I'll turn the mic over to Chris Walker to share more about our team here in the Bay Area and how to get started with Taylor Morrison Home Funding.
Oh, thanks so much, Deanna. Really do appreciate the overview. Hello, everybody, and thanks for joining today. My name is Christopher Walker. I do oversee the West Coast regions of Southern California, Sacramento, Portland, Seattle, and the Bay Area. My loan consultants, we have 6 that work the region for Northern California, and I've been with the company for 14 years. I've worked with a home builder for 17, and I've been in the industry for 20 years. And love every minute of it, honestly. And I love the team that I work with. It's been one of the key variables as to why I've been in this industry so long and love what I do. Dee gave a fantastic presentation. I can tell you we utilize our Aero program quite often. I did have a recent situation over the past few weeks where we had some buyers who unfortunately had a few medical collections hit, very, very small $35 and $50 amounts. It's highly unfortunate, but it is common. I'm sure we've all dealt with it in the past where a random account that you thought was going to be covered by your insurance never got relayed back to you. And lo and behold, it hits as a collection item. I was able to work with Dee when it hit these buyers' credit reports in the middle of their purchasing time frame. Was able to reach out to Dee, have her run some software analyzation for us, tell us what we can do. The scores had pulled the buyers well below qualifying, and with her assistance, we were able to move some things around and get them back into a qualifying level so they can meet their close date. It was a fantastic win for everybody involved, and our buyers were truly appreciative of what we were able to do to help them move quickly to get them back into a good buying power position. So with that being said, I am going to talk about a few things that come into play when it comes down to the type of loan programs you're looking for and what mortgage actually suits your needs. So Christy and Deandra discussed the basic loan qualification criteria and provided some tips on credit score enhancements. We're going to talk briefly on the most common loan products, including some of their overall features and benefits. This slide that you're looking at here contains a lot of information, but we're going to go ahead and try to break some of it down for you. If you guys have any questions, feel free to put it into the chat and we'll make sure we get them answered for you. So your most standard loan program is a conventional loan. It's a non-government loan. It's our most common mortgage product in the Bay market. There is a typical expected down payment of 20%. That's a misconception that a lot of buyers have. Actually, you can put down as little as 5%. There's even conventional loans that are specific to first-time home buyers with only 3% down payment requirements. And conventional conforming loans have maximum loan amounts that could range in the $647,000 range. You have high balance conventional loans that'll go up to $970,000. And these are actually based off of the county that you live in. Fannie Mae and Freddie Mac actually sets county loan limits where they will go ahead and issue loan products up to those amounts. And it is going to be best that you are speaking with one of our loan consultants to better understand what those loan amounts limitations can be. Actually, we are getting word just over the past week that the minimum conforming loan amount of $647,000 will be increasing again next year, potentially in the lower 700 range. So that's some fantastic news because it does open us up for some additional options for our borrowers. VA and FHA loans are established by a government agency. A VA loan is an excellent loan product for active duty or military or veteran military service members only. There's little to no down payment required. There's flexibility with higher debt to income ratios requirements and lower minimum credit score requirements compared to conventional loans. And if we're looking at an FHA loan secured by the Federal Housing Administration and requires only a 3.5% down payment. A common myth is that FHA loans is for first-time home buyers only. That's actually not the case. There are loan amount restrictions based on the county loan limits, just like I had mentioned before. However, there's much more flexibility when it comes to debt ratio requirements and credit score requirements, just like our VA loans. These government loans are highly valuable and highly utilized in our Bay markets as well. We do them all the time, and we're well versed in how to do an FHA loan. The last one that I want to talk about, the second to last one is our high balance loans. So the high balance loans is also a Fannie Mae and Freddie Mac product. They're still considered a conventional loan. Our higher priced housing markets may have loans that are available over $647,000, but not going above $970,800. Our high balance loans are typically less restrictive than our jumbo loans, which I'll speak to next. But they also carry a higher rate than the standard conforming loans. And it's because they're a part of a higher risk category for going above the standard conforming loan limits. But they do also give us the ability to potentially do these higher priced loans with only 5% down. It's another product that we use quite often in the Bay market and some of my others across the Western region. The last one I wanted to talk about was our jumbo loans. Jumbo loan is a loan that has a loan amount above those Fannie Mae and Freddie Mac loan limits, which are government agencies who buy the mortgages. Conforming loan limits, like we said, start at the 647,200. These are above that mark. These loans are typically offered by institutional investors and banks. These loans are designed to meet the needs of high income earners who are purchasing a higher value home. So again, not sellable to Fannie Mae, Freddie Mac. They're what you call a portfolio loan, meaning you don't have the ability to sell them off. They are typically a little bit more restrictive than the Fannie Freddie loan products that we're talking about, but they do have a lot of advantages as well. These are our most common loan types available, and we have many different offerings at Taylor Morrison Home Funding to meet the buyer's needs. So let's move on. We're going to talk about total housing payments. This is where we talk about affordability. So what makes up the total housing payment? There's basically 5 key components. Principal and interest, property taxes, homeowner's insurance, mortgage insurance, and that's only if mortgage insurance is required for that specific loan product, as well as your homeowner's association dues, or HOA, which are paid separately to the association versus the lender. So when we look about how much you can afford, we've mentioned debt to income ratio a couple of times, and now it's definitely a critical piece of your loan approval. Your debt to income ratio, what we refer to as DTI, truly tells the lender how much you can afford. The ability to repay, as we call it, is a very, very key component in all of this. And the standards basically got reset after the market crash of 2008. The debt ratio calculation compares how much you owe monthly against how much you earn, that gross income that Christy was speaking about earlier. When you're looking at your gross pre-taxed income, the lender wants to be certain after paying your new mortgage and credit obligations, you have money left over for all the other expenses. This includes your federal and state income taxes, the basic needs such as food, clothing, childcare, utilities, insurance, things like that. A solid rule of thumb is to not have your housing and monthly credit expenses above about 40% of your gross income. That's a good starting point. With that being said, there are loan programs that will actually allow you a higher debt to income ratio, upwards of 50%. Those can be considered for mortgage qualifications such as FHA and VA financing that we touched on earlier. To justify higher debt to income ratios, you would typically need strong compensating factors such as credit scores, credit history, cash reserves in the bank, sometimes 401k or other assets can be utilized that will allow for our automated engines to approve higher debt ratios. To calculate your debt to income ratio, you'd consider your proposed new housing payment. We refer to that as a housing ratio, and only your monthly credit expenses. Your housing payment would include the monthly principal and interest on your loan, the homeowner's insurance, monthly real estate taxes, monthly mortgage insurance, if you had that for your loan program, and any monthly homeowners association dues for the community, the HOA dues that we talked about earlier. You would then add your minimum monthly payments reported on your credit report and divide that amount by your gross monthly income. This ratio helps you and the lender determine your personal affordability ratio. Please keep in mind the expenses like groceries, utilities, gas, childcare, things like that, they're generally not included in this equation. So that's about the affordability of the home. I'm going to move on. We're going to talk a little bit about Dorothy. Dorothy's our mortgage technology platform, again, that Christy had spoke about earlier. So at Taylor Morrison, we understand purchasing a home is not something that happens often in someone's lifetime. It's both a financial and emotional commitment, and likely the largest purchase you're going to make. It's very important that we're here for you and able to help guide you through every step of the way. As we wrap up basic mortgage qualification, Dorothy is what you're looking at here. And just like Dorothy from The Wizard of Oz, Dorothy's here to help lead you down the path, your personalized yellow brick road, and provide you the state-of-the-art secure mortgage technology. Dorothy also works alongside our local Taylor Morrison home funding team to bring you the utmost superior home financing experience by coupling technology with the much needed personal touch service. With the protection of the industry standard encryption technology, you can trust that Dorothy, with anytime, anywhere account access and secure document transfer alongside real-time loan information. So as we go on to this next screen, this is where you're going to get started. I'd seen it earlier in the chat group as we had started this entire conversation. Somebody was asking, well, do we need to pre-qualify first through this, submitting an application, or can we go into the sales office? Quite honestly, you can walk right into a sales office to get started. And when the time is right, you can go on to this Dorothy portal here to get started with your financing pre-application, as we call it. So whether you're ready to pre-apply, possibly considering our Aero services that Dee was just talking about, or just simply want to talk to a mortgage professional, you can get started by going to this website here. If you're seeking Aero counseling, you can get started with one of our professional loan consultants who can run a credit simulator for you and connect with one of our Aero consultants to create the right path towards financing or purchasing the home. And if you want to pre-apply for financing and gather some details on what you would qualify for, simply going to the Start Your Journey tab at the top of the page is where you want to get started. You'll select the area, your community of interest. So you'll be looking at the market that you're looking to purchase in, being the Bay. Then you'll select the community that you're potentially looking at purchasing in. And then you'll be prompted through some customer-friendly finance questions just to get the ball rolling. And then once you've submitted your request, one of our local consultants will be in touch with you soon. So a few things we wanted to point out, and a common question we get is about a credit report pull. So it's different than as it was in the past, where a hard credit inquiry was required to actually run some of these details for you. We actually now only do what's called a soft credit inquiry at your initial pre-application. A hard credit pull inquiry is only needed if we were going through the Aero process for credit simulation. It is required that we had all three reporting agencies on hand to run those simulators for you. Or if you're taking a formal loan application after you've gone into contract. But at the time of pre-application, where you're just looking to go ahead and get some basic information about your qualifications and estimates, any things like that, or loan products, only a soft pull is required. Now, if you just have general questions and want to talk to somebody, you can also click on the Talk to Us tab. You're looking at it here, request to speak to a local loan consultant. You can send an email that goes directly to the Northern California loan consultant team. And you should hear from a team member just within a few hours. I can tell you I'm on this email distribution as well, so I do see these when they come over. We're constantly monitoring those to make sure that we can reply to you quickly and help you with any questions you have. So with that, we hope we kind of expanded your mortgage knowledge just a bit, and we want to thank you guys for spending the time with us today. I'm going to take myself off of the camera there. I wanted you all to see my face, see who you're working with. I know that I'm going to be turning this back over to Veronica so she can take you guys to the finish line. But I just wanted to take the time today to say thank you, Christy. Thank you, Dee. Thank you, Veronica. And again, if you guys need us for anything, please feel free to reach out. We're definitely here to help. So Veronica, I'm going to turn this back over to you, and I'm going to kind of let you get us to the finish line.
Thank you. Thank you so much. I really loved that. I feel like I know everything now about mortgages. So where to go now? Well, if you haven't already figured out where you want to live, we have so many tools available to you, online, offline, but first of all, you probably are going to want to get on the website and either take a virtual tour or start talking to our internet home consultants. Again, ours is Camille, who's all over it. She'll call you right back. She'll respond. You'll hear from Camille if you need help. You can also get online and well, you'll hit up Dorothy, like Chris was mentioning, and you can find out how much you qualify for. So, you know, that is important to know right off the bat. Yeah, reach out to them and they can help you figure that out. So again, if you can forward that, that would be great. Thank you. So yeah, once you figure out kind of where you want to live, then you can go directly to the community website. We have all the floor plans, all the prices, descriptions of what you're going to have around it. And then you can reach out to Camille again to either set up an appointment, or you can reach out directly to the sales office to get more information. We also have brochures online. Can you forward that one more time, please? Thank you. We also have brochures online that you can print out if you want to, or just look at them online. We have virtual tours again, and there's Camille's number right at the bottom there. So we also have a tool that you can, if you see something that you like in Pittsburgh there, you can reserve that home. That reservation is good for 48 hours. And during that period, you should either call or email Camille or get online with the sales agent, the community sales manager that is there at the community, and schedule either an in-person tour or a virtual tour. They're happy to get online on a Zoom call and I don't know, take their iPhone and show you what's going on in the home. But yeah, so these are for homes that are going to be ready now, and we have a few of those. But yeah, so to reiterate, your next steps, one more, your next steps are going to be to set up an appointment. But do let us know if you are working with the real estate agent. We want to know. We love having our partners in the resale industry bring us buyers. We just love that. But we do need to know that very early on in the process. So please make sure that you either let Camille know when you're talking to her, or the community sales manager when you go into the community. So yeah, and then as we mentioned earlier, hit up Dorothy and figure out how much you qualify for. But yeah, just ask us. We've got so many people who are here to help you, and we want to make this easy and a fun, happy experience for you. So we also want to talk about something that we haven't had in a long time, and that is a home that is ready now or will be ready in 2 to 3 months. So there's a lot of reasons to do this. If you're worried about interest rates, this is something that you'll probably really like, because you can lock your interest rate. You just will know all of your costs right off the bat. You won't have to wait for the home to be built, or you won't have to wait as long. I mean, we're probably putting the finishing touches on the home, but you won't have to wait very long, as long as you would if the home were, from the ground up. That typically is more like an 8 or 9 month time frame, but it could be longer. The selections are already there, so you will know exactly what's going to be in your new home, and you also get the same warranty. So, which is something that I do have to add that you won't get in a resale home. So that's another reason to buy a quick move-in home. And so this is something that when you talk to Camille, she can tell you, she knows exactly where we have homes that are ready to move in, and where you might have to wait a little bit longer. So do reach out. I do want to announce that I saw that Mohammed had a question in there. Are you offering 4% of you'll cover up to 4% of closing costs? Actually, what we're doing for homes that you purchase before the end of the year and close before the end of the year, before the end of 2022, we are offering 4% of the sales price, so toward closing costs. So that ends up being a lot of money that you can use with our mortgage company to help you create help your financial situation the way it's best suited to you. So that is something that Christy's gonna run through now on how exactly you could use those funds. And like I said, it winds up being quite a lot of money to help you. So I'm going to turn it over to Christy. Thank you.
Thanks, Veronica, and Chris, feel free to chime in too, because this is what you and I do every single day. And as Veronica mentioned, 4% of a total purchase price, compared to, you hear percentages a lot when you talk about loans. If you hear about rates and discount points, that's a percentage of the loan amount. And what Taylor Morrison's offering is 4% of that total purchase price. And we'll show you in just a moment just the impact and the power that has on affordability over price reduction, quite frankly. Let's just call it what it is. And there's many ways that you can use these funds, and there are quite a few of them are listed here. Whether it is towards those closing costs that we covered earlier, and maybe cash out of pocket is what is extremely important after your down payment. And recognize, I will tell everyone, the number one driver of a purchase decision is going to be your monthly payment. The second largest driver of your consideration of purchasing is going to be cash out of pocket. So when we're able to take these dollars and truly essentially roll back interest rates to where they were earlier this year, if payment is going to be the factor and you're going to be in the home for a long time, that permanent buy down on an interest rate might be the way to go and save money over the life of the loan. Something that is very unique to home building and new construction is what's called a temporary buy down. And a temporary buy down, and we'll show a graphic on this in a moment, but that would be a permanent fixed rate that for the first 2 years you're in the home, the seller, Taylor Morrison, is going to subsidize the payment for you for those first 24 months. So it really does help a consumer ease into home ownership. So if you've been renting and you're starting your career, or that there's a car that's going to be paid off in the next 24 months, this is a great option to ease into home ownership. Mortgage insurance, that is sometimes the dirty word of conventional financing. Everybody's saving up their last penny to put down 20%, or maybe selling a home that gives them enough equity to put down 20%. And 20% is that key number that does keep you from having private mortgage insurance. But private mortgage insurance comes in many forms, and one of those is an upfront premium. So if you have, 15% to put down or 10% to put down, and you're concerned that you're going to have a mortgage insurance premium on your monthly payment for the life of the loan, or for a considerable time on the loan, we can pay that for you upfront with these dollars and really help with affordability and really not have to worry about a future refinance. And then long-term rate locks. Obviously, the shorter the build time, the faster you can lock in your rate. But if you are looking at new construction, we do offer 6, 9, and 12-month interest rate locks. So that is another way to kind of layer up these incentive funds for you. And you can do a combination of 2 or 3 of them, because I'd be strong. I think I'd be strong to say, Chris, that those 4% funds cover quite a bit. Is that right?
Oh, absolutely. And every buyer that we speak with, we want to break this down on an individual level. We don't want to go ahead and shove everybody into a specific category, because like you said, it's what works best for them, for their specific situation. And like you had mentioned before, a home to sell means that there could be some variables as you're navigating through 2 homes at the same time. So what we want to do is create the peace of mind for you to know that depending on where those variables take you, we can go ahead and navigate you through what still may work best for you, even if it changes throughout the process. So the builder's main priority is to give you the funds to work with, knowing that this could be an evolving process throughout the construction period or the escrow period. So our loan consultants at the time of pre-application are trying to help you hammer out what your options are from the very beginning, even if they happen to change.
Yeah. And then on this next slide, just again, we'll be sending this to you so you can really absorb it. It's a lot of numbers, but just kind of pointing over to the left, I mentioned earlier, you know, when you take dollars and you compare that for dollar reduction of price, this left infographic really does show you if you were taking a price reduction with no financial incentives, you're technically paying more for the home, borrowing more money. You're paying less for the home, borrowing less money, but you have a higher payment, which, you know, until you really see it side by side, it's like, huh? But we show an example here of the 15% down payment option. Again, keep that 5% in your pocket. You are going to borrow a little bit more money, but with mortgage insurance covered, still having money towards closing costs and being able to permanently buy down the rate, your payment will be less than if you had paid less for the home. So that's just a really great example to show the buying power that you have there. And then over there on the right, the ease into home ownership, this is giving you that example of should you choose to do the temporary buy down, that kind of shows you what happens in those first 2 years. This is what we call a 2-1 buy down. So it's a reduction in your payment for the first 2 years. You would be making a payment 2% below your fixed rate for the first year, 1% below your fixed rate for the second year, and then your rate is fixed for the remainder of the loan. So sometimes people get a little confused and think this is an adjustable rate, and it's absolutely not. It is a buy down fund that these sellers' incentive funds are set aside to help subsidize that payment for you for 2 years. So those are just a couple of examples, but as Chris said, we're here to help tailor whatever's going to work for you, and maybe what sounds great today in 6 months, if you're buying a longer build time home, or even in 3 months, you could certainly change it up. So Veronica, I think you're going to take us to our wrap up here on what Taylor Morrison is doing for those of us that are on the home buying webinar today.
I just think that's so great. You really do get a lot more bang for your buck. Yeah. Thank you. Great job, you guys. You really do get a lot more bang for your buck with the closing cost incentive. I also want to mention, finally, we are so grateful to everyone who has come to listen to our seminar. We hope you learned something. And we are offering if you purchase between now and October 31st, we will also, in addition to the 4% in closing costs with Taylor Morrison Home Funding, you will receive a GE Appliance Package, and that is a washer, dryer, fridge. Just when you purchase, present the voucher to your community sales manager, and we will include the appliance package to you at no cost. So just as a thank you for coming today, we really appreciate it. Just be sure to present that, and it's all good. So thank you so much. We cannot thank you enough for coming. Hope you got something out of it. And again, we will be emailing the presentation out to everyone. Any other questions, please go to bayonline@taylormorrison.com, and it'll be routed to the proper people. So thank you again. Enjoy the rest of your day, and we hope to see you in our community sales offices soon. Thanks again. Bye-bye.
Thank you.
Thanks so much, Veronica.
Thank you.